You know, the question that probably comes up the most is how long will industrial stay at the top of the market in terms of investor popularity? And I would say it's going to be a while. Although we see some softening right now in the short term, some oversupply right now, particularly in major markets in the short term, the anticipation is the construction supply pipeline is going to slow, and I'll get into that in just a minute more. But bottom line is the strength of the industrial market looks poised for growth for many years to come, and I would say consequently it will remain at the top of the charts in terms of investor popularity. The counterpoint, of course, to remaining the industry darling is what about oversupply risk? In the short run, we do see oversupply relative to absorption. In 2023, we're delivering another 550 million square feet of industrial, and that will outpace absorption for the year, raising vacancy rates modestly. However, if you look at 2024 and beyond, basically over the next 5 years, we're going to see a fall off to an average of 200 million feet per year. So in the mid to long term, the outlook for industrial is very strong. So the fundamentals look good, especially when you consider the supply fall off beginning in 2024. But what about interest rates and the impact on pricing? No question there's been an impact. Very difficult to broad brush the entire market because you have considerations as sub-market, vintage, configuration, existing rents relative to market rents. But the short story would be cap rates have moved anywhere between 75 and 150 basis points on the averages. So if on the averages cap rates have moved 75 to 150 basis points, that would mean some deals are trading with negative leverage. And it's true. So what would cause an asset to trade with negative leverage today? It's a number of factors, but included among the factors would be, one, where are the rents in that asset relative to the market, and how fast can I get those rents to market? Another consideration going to the other end of the spectrum is new property. There's a broadly held belief that construction costs will only continue to increase. So if I buy a new asset today, I am automatically locking in a low basis relative to where newer properties will be years down the road. And correlated to that will be upward pressure on interest rates to come. One more time, especially in an environment where the supply spigot is going to turn off considerably. Again, that would be very contingent on location, configuration, existing rents for starters. But the reason industrial assets, certain assets would trade with negative leverage is the anticipation of moving those rents in the relatively new term or going to the other end of the spectrum. In a brand new property, I am locking in a basis today that is already going to be lower than the basis will be in the future for new construction. So where does that take the transactional environment in light of the fact that interest rates have clearly caused some pullback in the marketplace? My belief is we're already seeing the gap in expectation between buyer and seller close. So I would anticipate that given the popularity of industrial as an asset class, we're going to see continued escalation of transactions as more and more equity earmarks industrial for either portfolio balancing or simply to participate in the industry and the expectations going forward.